Hello and welcome back to our Investing Fundamentals series on GabelliTV. As I'm sure you know by now, I'm Miles McQuillen, Assistant Vice President on the Private Wealth team here at GAMCO. Over the last few weeks, we have seen increased market volatility, primarily sparked by concerns about a potentially slowing U.S. economy after a few weak data points on unemployment were released. From this, the markets are now pricing in the notion that the Fed will cut the federal funds rate in September, marking the first cut since 2020. Given this backdrop, markets have seen the 2-year and the 10-year Treasury rates fluctuate. Today, I'm going to discuss at a high level what these rates are and what their movements typically indicate. In the fixed income market, the 2-year and the 10-year Treasury rates are key indicators that offer insights into economic expectations and interest rate trends. The 2-year Treasury rate reflects investor sentiment about the short-term economic conditions and the federal funds rate monetary policy. It tends to be more sensitive to immediate changes in interest rates and inflation expectations. A rising 2-year rate often signals that investors anticipate higher short-term interest rates, potentially due to expected increases in the Federal Reserve's benchmark rates to combat inflation or adjust for economic growth. In contrast, the 10-year Treasury rate is a benchmark for longer-term borrowing costs. It is influenced by expectations about long-term economic growth, inflation, and overall financial stability. This rate generally provides insight into investors' sentiment about the future state of the economy, including anticipated inflation and long-term trajectory of interest rates. A significant difference between the 2-year and the 10-year rates, known as the yield curve, can indicate economic conditions such as growth expectations or potential recessions. For instance, an inverted yield curve when short-term rates are higher than long-term rates may signal investor concerns about future economic slowdown or recessions. Next time on GabelliTV, we will continue to discuss the difference between the 2-year and the 10-year rates, but hopefully this provides a good baseline for how and why these rates move. Thank you for tuning in, and we will see you soon.